Uh,
as it's utterly just chaos what they're doing here to the American people, to average everyday families, and to the banks, as we're seeing. This bank failed because of depositors withdrawing their money and their stock collapsing, and they couldn't recover from it. And it's unbelievable here. This is the fourth major bank to fail this year, worth tens of billions of dollars here. And the bank that's supposed to merge with them or, save them, the bank that is supposed to, save their assets and, take them in and, take over their assets, is a smaller bank than them. So this is, the Fed jumping in there and then the Treasury jumping in there, and these banks are supposed to save each other when they fail. This is a massive problem here, and the Fed is only making things worse for the banking, the the banks, the whole economy, and now average everyday Americans. And then the Fed makes this major decision today. It's absolutely just ridiculous. I'm going to show you what Jerome Powell has to say today. Really quickly, I want to show you also what happened here today, completely out of left field. Hunter Biden, who was expected to plead guilty as a plea deal, at the last minute pleads not guilty as the plea deal falls apart on gun charges and tax evasion. Yeah, so this was a completely just out of left field, and the DOJ prosecutors said Hunter Biden is currently under investigation, and this has turned into a full-blown circus. So I'll keep you up to date here on that, as this was not expected. So we'll see what happens with that. And even more of a circus is what Jerome Powell and the head of the Fed is doing to the American people, doing to the economy, and doing to the banks. Here's what he has to say here. Take a listen.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a quarter percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, Total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation.
Yeah, so the Fed raises interest rates here yet again, a quarter of a percentage point. You can see here the Fed raises interest rates to a 22-year high as it continues to fight inflation. This is their 11th interest rate hike, almost in a row. They had one pause in there. Its most aggressive interest rate hike cycle in 40 years. Yeah. You can let me know your thoughts here on this. This also comes here as we have another massive bank failure. PacWest Bank, thrashed by deposit crisis, will be taken over. Yeah, this comes as they had a massive deposit crisis and massive withdrawals from their bank, had a liquidity crisis, and could not recover from it. Bank of California is set to absorb PacWest because apparently it seemed like that was the only bank that would step in and help out, the only one that was willing to do so. And here's the issue. Let me know your thoughts on this. PacWest Bank had total assets of $44 billion at the last reported assets sheet of it at the end of March. Bank of California, who is going to absorb them and the toxic assets of them, only has assets of around $10 billion. So they're going to absorb the toxic assets of this failed bank that was 4 or 4.5 times larger than the bank was absorbing them. Bank of California is absorbing the now failed bank, PacWest, who was 4 to 4.5 times larger. Yeah, does this leave confidence in you in the banking sector? I'm not sure. Yeah, this comes as massive storm in the background. Yeah, the $1 billion each. And two of them were over $200 billion of assets each. We also had another massive bank failure, a worldwide bank that was worth over $500 billion. Yeah, so this just shows you the bank failures are not done. The Fed is not done. Every time they're raising these interest rates, or even just keeping the interest rates high for a prolonged period of time, is just keeping the pain and the